Hello, welcome to our Levered ETF series. My name is Rob Reinhold, and we're going to be talking about the FAZ in this session. Now, when I started trading in the mid-90s, these ETFs were brand new. Before we get into the levered ETFs, I need to cover very quickly what an ETF is, just in case anyone out there doesn't know how they're built. Whenever you hear the term the stock market, that really doesn't mean anything. Look, there's several different exchanges where stocks are bought and sold on a daily basis and they go up and down. There's really no way to say, hey, how are all the stocks doing? And so they created these things called indexes that you could actually track what the market was doing, like the Dow Jones Industrial Average, the Standard & Poor's 500, the Russell 2000. And they created these as a way for someone to look at this number and say, oh, the market went up today, the market went down today. But it was just a collection of those 500 stocks that they put in there. In 1993, a firm called State Street created the first exchange-traded fund called the SPY, or as was called the Spiders. This was developed to deliver the same return as the S&P 500 index. The great thing about these is it was a stock. It wasn't a mutual fund. It wasn't indexed. It could be directly bought and sold like a stock at any time at a really cheap price. This was a great alternative to mutual funds. Before ETFs, if you wanted to get the same return as the market, you had to pay a company probably somewhere around 0.5% or 1% to run the money to try to get you the same return. Now it's as easy as just buying SPY. And these have options, which is awesome. We're an options trading firm at Maverick, so we absolutely love options on these ETFs. So here is the Russell 1000 financials, ticker symbol RIYFC. Now, this is an index. Remember, an index is not a security. You cannot buy and sell this index. It simply is a made-up thing. But this is what is the tracking mechanism behind the FAZ. Now, before we just jump in and say this is the one, we have to go over some news. Based on when you see this, you're either going to be interested in the Russell 1000 Financials 40, but effective August 1st, 2022, the Direxion company that runs this fund is switching over to the Financials Select Sector Index, which is the IXM. So before August, it's going to be the Russell 1000 Financials. After August 2022, it's going to be trying to track the IXM. So this is the Financial Sector Index, and it is a weighting of several large companies. You can see Berkshire Hathaway is 10% of it. JP Morgan, Bank of America. You've got Morgan Stanley, Goldman Sachs, S&P Global. So a big mix of financial companies. Now this IXM is simply going to track those companies as a basket and give you a price. Now again, you cannot trade this directly. In order to trade this directly, you need to find an ETF that fits this. Now, we're talking about levered ETFs. So let's say that someone wants to get the same return of the IXM times -3. That is going to equal the ticker symbol FAZ. The FAZ is simply an ETF that is trying to return -3x of either the Russell 1000 Financials or the IXM based on your time. When Direxion runs this fund, they're not buying stock in financials. They're buying things like options, futures, derivatives. Remember, their goal is to try to return -3x the return of the IXM. That's their job. Sometimes they do it well, and sometimes they don't. Here is a side-by-side comparison. The IXM on the left, the FAZ on the right. And I'm going to run these simultaneously. And you'll see that they are inverted of each other. When one is going down, the other is going up. When one is going up, the other is going down. This is the goal of the FAZ, is to give you 3x the negative return of the IXM. When the IXM is falling, the FAZ is rising, and vice versa. This is an inverse levered ETF. Let's talk about how and when to trade FAZ safely. First off, we're going to talk about using it as a short-term trading vehicle. So you're basically just going in and buying and selling the shares. So we can look at a day trade or we can take a look at a swing trade. We don't like anything past about 10 to 15 days on these levered ETFs, and we'll get into exactly why that is. Let's take a look at using this FAZ as a short-term trading vehicle. Here's the FAZ. On all my other levered ETF videos I've always done like a swing trade or a longer term trade. For fun, let's do a very short-term scalping trade. Now I'm going to be using the bar replay feature. Now the bar replay feature is on TradingView. It's awesome. And you simply hit this little bar replay button and you say, okay, I want to go back in time. I'm going to go down to a 15-minute chart. And we're going to make trades based on the 15-minute time frame. Now with the bar replay, what you do is you simply go back in history, and anywhere you click, it is going to start the chart up at that moment. Right where I clicked, that's where we started out. So at one point, this was exactly what this stock looked like. So let's make a trade based on this. I'm going to hit the play button, and I'm going to wait until there's a good setup. Now for me right here at Maverick, we have a very, very strong belief in trend following and using moving averages. And so until these moving averages, these two lines, this red and orange line, start to go higher on a steep way, we are not interested. So let's go ahead and just hit the play button. Remember, we are not interested in going short. If we were to go short FAS, it means we were long financials. And then we would just want to use the long ETF to go long. So this is only for going long on any of these levered ETFs. So we're now above the moving average. You can see they're starting to turn cross higher. It is still way too early for me. And frankly, I actually want to see this high broken before I really even get interested. At that point, if it does break this line, this resistance, these moving averages are going to be steepening nicely, which is a very nice setup. So let's see if we can get up to that line. Okay, we're starting to get up to that line. And you can see we're starting to get a nice turn in these moving averages. So I'm just going to go ahead and place a buy stop up there. So I'm going to put my buy stop at 23.90. 23.90 is going to be the buy stop. And you can just stick it out there. And if it doesn't go above that level, you don't even get long. You don't even buy. It just never happens. We love to enter orders at Maverick like this. Let's see if we get filled. It backs off that. Okay. So we put in our buy stop at 23.90, but you could see there was a gap. This was a gap from a different day. And you can see that we would have been filled at 24.02. So the actual fill would have been at 24.02. That's where it would have been filled at the beginning of that candle. Now, every single position needs protective orders. And the most basic protective order is a stop. We don't love stops at Maverick. They're too basic. But for this example, let's use a stop. And we love to use the concept of a trailing stop. We're going to use this red 20-period moving average as the stop. That means what we're going to do is we're going to say, okay, well, we want to put in a stop order. And it's going to be below this 20-period moving average, somewhere around 23. Trailing stop, 23.35. So that trailing stop is going to be out there. And what we're going to do is we're simply going to move this. As the position moves higher, we're just going to be moving up our stop. Now, this is where people always get it wrong. We had a nice run. And everyone's like, you know what? I'm going to go ahead and sell 24.02 to 25. That's a 1 point gain. That's a huge gain. That's like a 4% gain. We don't do that at Maverick. This is a good one. Your good ones are likely to go even more for you. And just think, how many times have you exited a good position and just kept going? Use this trailing stop. Until it breaks below this 20-day moving average or 20-period moving average, we're very happy to be long. And you can see at this point, we have basically moved up our stop order to pretty much break even. At this point, we are playing on the house's money. If it does break below that line, we're going to get out. Until that happens, we are going to be very happy to sit in here. Okay, again, this is why we use these trailing stops. So we move this trailing stop up somewhere around 24.90, and we let it keep going. The stock will tell us when to exit. And there we go. There's our exit. And let's call that 25.20. So the exit was at 25.20. And you see how using this trailing stop got you some extra? Yeah, it got you a little bit extra. There was no discretion. There was no fear. There was no, should I sell here or sell not? It's just simply following rules. So this is a $1.20 gain. This is a 5% gain on a pretty short period of time. This is a very short trade on this one. As you can see, these levered ETFs, they work just like a stock. You buy them, you sell them, and they're basically a stock. However, there are some things that are a little different, and we need to talk about that. And there are some things that make these a lot riskier than just a normal stock. The first thing we need to talk about is what's called the return differential. Now, as you can see here in 2022 of February, the financial sector actually went lower 0.5%. Now, you would automatically say, okay, well, this is a inverse levered ETF, so if it went down 0.5%, it probably the ETF went up 1.5%. Wrong. It actually went down 4.4%. People say, well, how can that happen? Remember, Direxion is trying with options, futures, derivatives to try to get a 3x inverse return. And sometimes they don't quite get it. And that's called the return differential. So this here is the return of the FAZ on a monthly basis over a year. And we're going to compare it to the IXM over a monthly basis. And basically what we need to do is we need to take month by month and say, okay, if the IXM did this, the FAZ should do negative 3x of that. And if it doesn't, what is the differential? And here is the differential on a monthly basis. And you can see it doesn't look all that great. If you've watched our video on the FAS, which is the 3x bullish financials, the differentials were tiny. And we said, hey, this is one of the best run levered ETFs we've seen. There's hardly any differential. We cannot say that same thing about the FAZ. And you can see that there was only 2 months out of 12 where you actually got a positive differential. There was 1 month, July 2021, where you got exactly the same 3x negative return. But most months you can see are not the same. They're actually like a 3 percentage point lower on average. Now, what that means is when you trade these levered ETFs, you think to yourself, oh, I've got 3-to-1 leverage. Not really. What you have is 3.5 times leverage against you and 2.5 times leverage for you. Again, I'm just rounding some numbers, but to make you understand that this is not like buying a stock where you buy it and sell it. There is a little bit more to this, and you have to be much better than 50-50 win-loss in order to make money on these. These return differentials, they get bigger and bigger over time. So imagine if you held it from February 22 to October, you can see that there is a huge, about a 10 to maybe 12% return difference between the two. When you're wrong on the trade, you end up losing more than 3x most of the time. The return differentials are no joke. The reason why we like these short term is because the shorter you hold these, the less this differential becomes an issue. If you just hold these for a couple of days, it's going to be very small. If you hold it for a week, probably not that big. If you hold it for 2 months, you're now looking at some serious problems with the return differential. In addition to the differential, they also have higher fees. As you can see, the FAZ's fees is right below 1%. Every time you buy and sell this security, you are going to be charged these fees. And then the sad thing is there's really no options benefit on these levered ETFs. Now let's talk about options trading with these levered ETFs. We are America's largest proprietary trading firm that specializes in options, and we love options on ETFs. Here's the problem. It doesn't make any sense to trade options on the levered ETFs. The options market is very smart, and it knows that this security is going to trade 3 times bigger than IXM. All it does is it makes the options 3 times more expensive than the IXM. So if you're going to be doing options trading, all options trading should be done on the 1X long financial ETF with the greatest volume, which is the XLF. This is going to have penny spreads. This is going to have a ton of volume. It's going to be so much better to trade here. Now you think to yourself, wait a second, Rob, that is the long ETF. If I want to buy the FAZ, it means I want to be short. Exactly right. Still trade the XLF, just trade the put options and put spreads on the XLF. All options trading, whether you're long or short, should be done on the XLF. And the last way we like the FAZ is to use it as a hedge. And this is just a wonderful way to use these levered ETFs. Let's say that there's a trader out there or an investor that is holding 100,000 long in financial stocks. And they like financial stocks at the long side, but all of a sudden, the market starts to look a little shaky. And maybe it's for tax reasons or for some other reason, they do not want to sell their shares. However, they think the market could potentially go down 10, 15, 20%. Instead of just sitting there and losing money and taking the pain, all they need to do is go over to the other side and buy $33,000 of FAZ. At this point, they've effectively hedged out their portfolio. So let's say the market goes down 10%. Their stocks are likely to go down right around 10%. The more correlated they are with the market, the closer to 10% is going to be. They're going to take a $10,000 loss on those stocks during that period of time. However, since they bought the FAZ, that FAZ is going to go up around 30%. It may be a little bit more, maybe a little bit less, but that return on the FAZ is going to be equal to about $10,000, basically removing any risk of that loss. This is how you use these levered ETFs as a hedge. One thing I need to talk about before I let you go here is risk. These levered ETFs are extremely risky. Now, they're risky because people put too much capital in these. These can move 10% very quickly. I've seen some ETFs move 30% in a day. These are risky. And if you have all of your account in there, and understand there have been ETFs that have gone basically to zero. They didn't go to zero, but remember, a 3x ETF. Let's say there's a 3x ETF and the underlying moves 40%. All of a sudden you're like, wait, that's 120% against you? Yeah. Now it doesn't happen that way. It gets compressed, but you're like 99% loss. You theoretically, if you hold on to these too long, it can wipe out an entire portfolio if you put too much capital on the line. So always follow proper position sizing. So we love these levered ETFs and the FAZ for a short-term intraday swing trade. All options trading, do it on the XLF, and absolutely use these for hedging. This is a great way, whether you're long financial stocks or even if you're long some financial options trades, maybe an option spread, you can always do some delta hedging. Just simply go out and buy these. It's very simple. There's no other Greeks that come with it. You just go in and you buy these and you hedge out your portfolio. Thank you so much for joining me. This is the Maverick Levered ETF series. Goodbye.